Sawadee Cup, Tuktan. Hello everybody, welcome to Global Talk. I'm Graeme Cunningham, Global Investment Strategist here at Asia Plus Securities. We've got several stories to talk about this week. A couple of political stories. One's the French election and the surge in markets globally that followed that. The Trump tax cut plan announcement and how markets were flat generally after that was announced. A review of U.S. first quarter 2017 results, and a quick overview of the pharmaceuticals sector as a defensive part of a portfolio. So first we'll go into the French election. On Sunday, there was the election in France. Markets on Monday surged, especially in Europe. France was up over 4%, Germany was up over 3%, and the UK up nearly 2%. Understanding the structure of the French election is important, putting this into context. How it works is there's a first round where if no single candidate gets over 50% or gets a majority, then they go on to a second round, taking the top two candidates in terms of percentage that they gained of the vote, and then they shift them into the second round, and they go head to head, and the winner of that is the winner of the overall election. So the results we had were a centrist party, so not really too far left and not really too far right, led by Macron, won with 24% of the vote. And the second player was Marine Le Pen and her far right party, which was 21.3% of the vote. There had been concerns prior to this of two main other outcomes that would be considered a problem by markets. One is that there would be a split between Le Pen on the far right and Mélenchon, who was part of the far left party, and that into the second round that would create a lot of uncertainty because it would probably split the population roughly 50-50, and we wouldn't be sure until the second round what would happen, but we would realize that probably severe policy change was coming regardless of who won. So markets don't really like uncertainty and those kind of things and major shifts, so that could have been a problem. The other potential outcome that people were concerned about, or markets were concerned about, was a Marine Le Pen, probably not a victory, but if she gained much more than the 20% she got, the 30 plus percent, that it was looking like she was going to win in the second round, that would have been an issue for markets, mainly because, again, of major policy implications involving possibly the future of the euro and the EU itself. If we go to the next slide. So why such a big jump in these markets? Especially since this outcome had actually been generally expected, that it was going to be the centrist party winning, and then Le Pen as the second player. One of the major issues was that people were concerned that if Le Pen won, that there might be an issue with the future of the euro currency. Brexit for the euro itself was not really a big issue because the UK already had its own currency, the pound. But France leaving, it is the second largest country in the EU, and Le Pen had been making some indications that there was the potential for an exit from the EU by her party. Germany is the largest economy in the EU, and if there had been an exit by that second largest player, there'd be a real question of why would the euro really exist. Which brings me to the second point, which is it's not just the future of the euro, but the future of the EU itself. So if you were to see France threatening to leave the EU, certainly countries that are already at the periphery, already making plans to leave, like Greece, Italy, Spain. There's a lot of economies that would like to have their own currency because it would allow them to run their own monetary policy, because right now these governments are effectively handcuffed by the euro. If they prefer to depreciate their currency, maybe run larger deficits, they're not able to do that because they're part of the euro. And they have to pass all these things through the European Union, in which Germany has a large say. And tends to be a more fiscally conservative country, and that sort of pulls in the average of all the countries, making them also fiscally conservative by default. So countries that wanted to spend more, are happy to depreciate their currency, weren't able to do so. So this was why this was such a big deal, such a huge lift to markets, and I think it really was very fundamental for the EU, not just France, but the EU and the euro overall. We saw the euro spike on this news. It's believed that in the second round, if we can go back to the first slide there. So it's expected in the second round that the centrist party is likely, as we can see, they got 24%, which I've circled there. They're likely going to get the far left vote and the left vote of the Socialist Party, because those voters probably won't go to the far right or the right. So you've got 50% there, and then if they get of the center-right party under Fillon, if there's 20% there, if they get a bit of that vote, and then they get some of the other, which is around 9%, they'll have a majority. So it's likely at this point, because of this result, that they'll win. So moving on to the Trump tax plan that was announced. This is another big piece of political news that actually didn't move markets much, in distinct contrast to the France election issue. So Trump's tax plan, really there's three main points to this. There's other details too, but the three main points are: one, he's going to reduce the U.S. tax code from 7 brackets to 3. He's going to have a major corporate tax cut down to 15%, and there's going to be a repatriation tax for companies that have, or multinationals that have a lot of cash abroad, can bring this back to the U.S. because Trump wants that money back in the U.S. and investing in the U.S. rather than abroad. Markets were up on the day before this tax plan, sort of as the markets were waiting. The S&P 500, for instance, was up, I think, at a peak of about 0.4%. By the end of the day, it was slightly below 0. So people weren't massively disappointed, but they certainly weren't excited by this. One of the reasons was just that was as simple as that it had been communicated to the market that this was one of their major platforms that they were running on ever since the run-up to the election. So this was, and then there had been not leaks, but there had been suggestions by members of the Trump administration about details of this plan, or broad strokes, I should say, more than details. So it was well communicated, so there was no real surprises. Some of the problems in terms of the market that the market was reacting to when it dropped a little bit was, one, there wasn't that much in the way of extra detail compared to what they've already released. So some examples would be, for the 3 brackets, what would be the income levels that would fit in those 3 brackets? For the repatriation tax, what would be the rate of the repatriation tax? Another problem that people had was that they're considering, can this actually pass? Because it's very sweeping tax reform. Nothing like this has really been seen for almost 40 years. So there's a question of, especially with what happened with Trump's major healthcare reforms, it stalled at Congress very early on. They tried to push everything through, but it didn't happen very quickly. And that's still in process now, weeks later. So there's a question of, will this be able to get through Congress? People are thinking probably not very easily. And then there's a question of, even if they can get it through, when would it really take effect? People are saying probably not before 2018. So if you're discounting that there's going to be a cut to corporate taxes this year, that's probably not real. That's probably a very, very aggressive assumption, and that it could be 2018, 2019 if it's passed late in 2018, before you're really seeing these effects come through into the valuations of companies. The other issue is, and I'm going to get into more depth on this, is funding. How are they going to pay for this? To get to the conclusion on this one, we need to look at the budget identity. So we can go to the next slide. So this just shows you the simple budget identity. It's quite easy to understand. It's government revenue minus government spending equals a deficit. If government revenue is over government spending, it's actually a surplus, but generally in the case of the US, we're looking at deficits. So we can see in this first example here, government revenue is 200, government spending is 200, deficit 0. The deficit also equals, you need to finance a deficit. So if you have a negative number there in the deficit, you have to have an offsetting increase in government debt. If you can go to the next slide. So this is effectively what we're seeing with this Trump tax plan. There's not really any major, from what I can see, there's not actually much in the way of spending cuts. There has been some proposed, but we're not really sure what those are going to be and how severe they're going to be, if they're going to be high enough to offset the decline in the government revenue. So for instance, in our example, government revenue drops from 200 to 100, and government spending is still at 200. Now you have a deficit of 100, so you need to add additional debt of 100. So this makes people think, okay, the benefit that I might be getting from the reduction, in terms of the overall economy, in terms of companies themselves, they may get this benefit short term of the taxes, but maybe longer term, because of a rising debt load in the U.S., that growth overall is curbed across the economy, which then trickles down to corporate growth, and that actually maybe companies will not be better off because all we're doing is just borrowing to finance present cut in taxes, which the government really doesn't have enough revenue to offset. If we look at the next slide, you can see what happens, the way that debt can build up if you continue to run deficits. So in our example, the debt was just 100. Fine, let's say it's in the first year. Let's say that debt to GDP, there was no debt. In our first year, we've got 100 in debt, and then we've got GDP of 1,000. No problem. Our debt to GDP ratio is very small. It's 0.1 times. If you run that debt up, if you run those deficits though for 5 years, now your debt's up to 500. Let's say GDP is not growing in this example, there's no growth in GDP. That would be a little bit pessimistic. But let's say 1 or 2% growth, not super growth, not amazing growth, so it's not a completely unrealistic example, especially given that debt is definitely growing much, much more quickly than GDP. So here we have, by your 5th year, you're looking at 0.5 times debt to GDP, and by your 10th year of running deficits at that level, you're looking at 1 times debt to GDP, so our government debt to GDP. And that's where the U.S. is right now. So they actually have a reasonably high debt load. It's not super extreme or a massive problem currently, but nonetheless, it's pretty high. If you want to look to a nation that really has a problem, you can look to Japan, where the government debt to GDP is about 2.5 times. So once you start to get over 1 time, that's probably, and as you head for 1.5, certainly as you get up to 2, that's where problems start. The U.S. is still at 1, so you could say they're not in major problems in terms of the deficit to GDP. But if Trump is going to finance this these massive tax cuts with deficit spending, as opposed to cutting government expenditure, that could become an issue, and we can see that debt to GDP number get higher and higher, becomes more difficult for them to cover the interest costs. If interest rates are really low now, if the interest rates go up, suddenly the debt service becomes an issue. So these things can take off very quickly, and it's just a question I think the market's looking at, is this really net going to be, without the detail being released, they can't tell whether this is going to be good for the economy net over the long term. So third one today, this is another, not political this time, but corporate economic news that also didn't really move markets much. These were the U.S. first quarter 2017 results. Reporting season began with financials about a week ago. So far, of the large cap Asia Plus universe, so far 23 companies have reported. 7 or 8 of those were financials. And a good 70 to 80% of them both beat their earnings estimates and had year-on-year earnings growth. So that's quite strong. You can see in the chart the green bar, which is earnings beats and earnings growth, is much bigger than the red bar, which is earnings misses and earnings contractions. So a really strong set of results. But actually, if you look at the markets, other than a boost on the day of the French election, U.S. markets really haven't done that much. They've sort of eased up a bit, but pretty interesting that it wasn't more of a push. I think to put this in context, like, why did this Trump tax plan and these U.S. results together not have more of an effect on the market? If we go to the next slide, this really shows another core reason for that happening is just that the U.S. is just overvalued versus the other global markets. This is a chart I've explained before. I'll just run over how it works again. On the x-axis, you can see there's ROE, which is return on equity, and that increases from 0 up to 18% in our chart. As you get higher and higher and higher returns, you would expect to pay more and more for those returns. That's the y-axis, which is the PB, which is the price to book. So as I head up for higher and higher returns, I'm happy to pay a higher price to book, which is the price of the stock, the price of returns effectively as they get higher. The line through the middle, the dotted line through the middle of the market, shows you roughly around where fair value is. If you put all the markets together relative to each other, you would expect that a fairly valued market would be right on the line. Anything above the line would be overvalued. Anything below it would be somewhat undervalued. And what you can see is France's market now is still very close to the line, actually, but that's after jumping up. So prior to this election, why was there such room for it to jump and move? Was that it was just relatively fairly valued prior to this election announcement, and even now it's not severely overvalued, just a little bit above the line. And again, given that that was such a major issue for the country and the region itself, not an unrealistic move to go a bit above the line on news like that. If we look at the U.S., we can see that it's one of the most overvalued. Although it has really high ROEs, 16-17%, its price to book around sort of high twos, high twos, about between 2.5 and 3 times price to book, is one of the highest markets above the line. So you have to take into account its returns. You can't just look at the returns. You have to look at what you're paying for those returns. You can see we're paying quite a bit too much currently for the U.S. relative to other markets. If you look at China, Hong Kong, and Korea, for instance, you can see that they're trading quite below the line. And we've said before that those markets, especially China and Hong Kong, are looking a little bit more interesting in terms of valuations than some other markets. So the last thing I want to get into, given that we've talked about some markets being overvalued, especially in the U.S., is more of a look at some defensive issues. I've talked before about short ETFs as a direct play. A short ETF, basically an inverse ETF, just gives you the opposite of a return of an index. So if the S&P goes up 1%, your short ETF can go down 1%, and give you a hedge or just a directional trade against whatever a downturn in the markets. Another way to do that is just to protect your portfolio rather than just doing a pretty overt instrument like a short ETF, is that you might only hold for a limited period of time, is you can put more defensive stocks into your portfolio. If you look at the next slide, we can see this gives us the percentage change in the global sector index for several different sectors since November 2016. So just before the election, the Trump election, and then what's happened since in this, what's effectively a very global Trump-based reflation play. And what we can see clearly here is that we've got, in the blue bars, we've got the absolute percentage change. Most sectors in the world, except for energy, have actually gone up 5% or more. But what's interesting is the green bars, which show you the relative performance. So we take the MSCI World as our core index. It's gone up 11.8%. And then we compare that return to the sector return to get a relative index performance. So we can see that certainly more defensive sectors, and defensive, the way we define a defensive sector is that when markets go up in a boom, it tends to not go up as much. But also when markets go down, a defensive sector tends not to go down as much as cyclicals. So if this is your defensive stock, kind of going along a line, cyclically moving along a line quite tightly to some sort of axis, your cyclical stocks would be doing this. They'd be moving much farther up in a boom away from the line, and then much farther down when there was a downturn. So it offers some protection to your portfolio, but in a time like the last several months, during the Trumpflation trade, what you're seeing is that people are ignoring defensives and they're going into sectors like you can see the big relative outperformers, materials, which is like commodity stocks, steel, cement, things like that, tech, which is your Google, your Apple, Netflix, Microsoft. Consumer discretionary, which will be things like retail, consumer retail, Nike, some of the French high-end brands, and industrials, which tends to be cyclical. Things like Caterpillar would be an example of industrials. And then, of course, financials, the highest outperformer, a very cyclical sector, for sure. And you can see the underperformers. If you take out energy, which is a pretty cyclical sector, is just having a sort of a bad time because of oil price movements relative year on year. You can see telecoms, consumer staples, which are things like packaged food goods. Packaged food tends not to have a huge increase in pricing and customers when there's a boom, but it also doesn't have a major fall when there's a bust. People tend to consume around the same amount of packaged goods. Telecoms, people tend to use their mobile phone whether there's a bust or a boom at the same level. Utilities, that's things like electricity companies. People tend to continue to use electricity whether there's a boom or a bust. There is some fluctuation, but not as much as some other sectors. And then we come to healthcare, which is interesting. It's in the middle, almost directly in the middle, because healthcare, and specifically pharmaceuticals, has an interesting profile in that it's a very defensive sector, but it also has some growth elements to it. If we can go to the next slide, I'm going to explain quickly that. So a pharmaceutical company usually has a branded pharmaceutical company. There's branded pharmaceutical companies that develop new drugs and then bring them to market. And then there's generic drug companies that just take existing drugs that have come off their patent and then they just reproduce them. So they don't really develop new drugs. So we're not worried about generics for right now. We're worried about branded pharmaceutical large cap companies. So what they'll have is existing drugs that they've already brought to market. The process took 20 years. There's a pretty clear, once people start taking a drug, it tends to be defensive. They don't stop taking the drug because there's a downturn in the market, and they don't take much more of the drug because there's an upturn in the market. It tends to be relatively stable. And the life cycle of a given drug is well known because there's a patent, and the patent expires, and when it expires, usually it moves over to the generics who take the chemical formula and then just reproduce it. But they're not allowed to do that until the patent expires, usually, which are around 20 years or so. So you have a fixed life for these drugs, and usually a given company is doing has maybe 5 to 10 big blockbuster drugs that were a success that are part of its cash flow, very predictable cash flow from that part of the business. But at the same time, they have a very important growth component, which is the new drugs. So the new drugs are in the pipeline. They're getting approval from regulatory agencies, and that process can take up to a decade or more. So at each step along the way, the market will, at first, as the drugs are going through early trials, will not be putting much value on a given drug at all. But as the drug passes more stages and it looks like there is a viable market for this drug and it works, and it goes from its development to animal testing to human testing trials, eventually the market starts to attribute more and more value to this drug. So you have this growth component that's embedded in the valuation too. The problem is at any phase along a 10-year journey, the drug can miss one of the steps, can fail a trial, not be fit for consumption by animals or people, or just not safe enough to be released, or not really do what it's originally intended to do, and then it can just be basically its value shot down to zero. The next chart here, the last chart for today, you can see what happens when a company, this is the market cap of Eli Lilly, a major drug company, over a couple of weeks at the end of November 2016. And we can see that one of its drugs failed one of the steps in this process, and it lost $8.8 billion in market cap, or a 10% drop in a single day. It has recovered some of that for some other news, but that's how you know. You don't really know how much the market is really attributing in value until you see one of these incidents happen, and you can see, oh, that drug was expected to be worth about $9 billion, discounted to the present. So that is the growth component of the pharma stocks. There will always be that issue there, but in general, this sector is defensive, and is so something that we wanted to highlight in terms of addition to a portfolio, especially with all this focus on growth and cyclical stocks now. Don't forget your defensives and have a look around at utilities, telecoms, consumer staples, and consider adding those to your portfolio also. So that is it for today. The two political pieces of news, the French election and the big move in European markets, the Trump tax cut plan and how it didn't move markets, the U.S. first quarter results, which although really good, actually didn't lift markets that much, and then a quick overview of the pharmaceutical sector. So that is Global Talk for today. Thanks for watching. Please leave me any comments or questions. It can be in English or Thai. I can read both those. And I'll definitely answer anything you put down there. And we'll see you next week at 3:30. So,